What is happening, guys? Hope everyone is enjoying their summer and taking it easy. In this video I'm going to be taking you through Tesla's Q2 report, analysing its performance since the start of the year and comparing it to the last 2 years to see if the company is on the right track. What I would say is that this is a really nice report, and if I wasn't already in Tesla, it's just made me even more bullish, to be honest, in the company. Firstly, we can note that there is a revenue increase. This alone doesn't tell us much. However, if we minus the cost of revenue away from these numbers, we get the company's gross profits. As you can see, we are running a really nice increase in terms of the gross profit, and the company's completely on the right track here. The gross profit margin is also really solid. And what we can take away here is that the overall consistent gross profit margin and increase in gross profit altogether is a good sign. Albeit we do want to see a higher percentage here. However, consistency is key, and the consistent rise is a good sign for the stock. The selling, general and administrative expenses consider direct and indirect selling expenses and all general and admin expenses. When it comes to this number, what we want to see here is essentially just a low number. This is just better in order for the company to turn more profits. Historically, Tesla has been really high here when you look at how much gross profit is spent on SG&A, but we are seeing a really nice downtrend here, and we are hoping to see sort of a consistently low percentage. Ideally, I'd like to see this number below 30%, and if you look at this downtrend, they are definitely on the right track for doing so. The amount of gross profit spent on research and development is genuinely a true killer of many businesses, especially in Tesla's sector, with them consistently needing to spend a lot here in order to stay competitive. Companies that need to spend high here are flawed in their ability to grow. However, it should be noted that this figure is in the right trend. The downtrend essentially indicates that Tesla does not need to use massive amounts of its gross profits on research and development in order to stay competitive. Currently, when we come to depreciation expenses, the amount of gross profit spent on depreciation is a little high. However, it should be noted that this is still a downtrend from its 2019 results. Furthermore, with a company like Tesla, we pretty much have to concede that this number will always be present, but I am hoping to see this under 20% soon. Now, I think the interest expense of Tesla is sitting at a good number. The interest expense of a company in respect to its operating income reflects the total debt the company has on its books. When a company is high on interest payments relative to operating income, they tend to be in a fiercely competitive industry where large expenditures are needed to grow. 9% is a really good number, and I think that definitely should be noted for an interest expense, and it's a sign that Tesla is a solid company which can self-finance projects and indicates that they're generally established now. Now, as we come to net income, as we can see, the net income from total revenues is up from last year, which is always a good sign, and it's generally in a really nice uptrend here. Net income is your business's profits after expenses and allowable deductions are taken out. Total revenue is just almost irrelevant unless a company is making net profit from it. However, we would like to see this increase from 7%, but as you can see, we're in an uptrend and we are on the right track to do so. Now, if we look at both inventory and net earnings together, we can see that they're both in a simultaneous rise, indicating that Tesla is finding profitable ways to increase sales, and the increase in sales has called for an increase in inventory, so the company can fulfill orders on time. Now we come to Tesla's return on total assets, which indicates how efficiently Tesla can make use of its assets to maximize profits. As you can see here, the number is increasing from last year from 0.52 to 2.98. However, it is still a low ROA, which is not a good sign altogether in terms of the growth of the company, as it indicates that the company is not able to make maximum use of its assets in order to generate more profits. It can be argued that a low ROA can indicate vulnerability. However, to be honest, Tesla is just such a powerhouse. I think they're an exception to that rule. Now finally we come to return on shareholders' equity. Return on shareholders' equity is calculated by dividing net earnings with shareholders' equity. Tesla is running a really low number here, and it indicates that their industry is overly competitive in order to grow. The low returns from Tesla indicate that the company is not making good use of the earnings it is retaining, but thus it is not increasing the underlying value of the business. It should be noted, however, that this number is still on the rise, thus it's not all bad. Now, overall, the conclusion I'd make here is that there's definitely some good points from Tesla. There's definitely issues still at bay, and as I said, this video is simply comparing the last 3 years, and I definitely think they're on the right track at the moment. However, if you look further back, there are still issues at bay that should be noted, and I'll probably cover those in a future video. But yeah, thank you very much, guys. Thank you for listening. Hope you really have a good day. And yeah, like, comment, and subscribe. Any issues you have with the video or anything like that, I'd love to hear them. Anything you want to comment about Tesla or any other stocks, please feel free to comment them and comment them below. Thank you very much, guys.